conflict in Ukraine, the war. And that really effectively knocks a lot of growth out of the world economy. So if you look at this chart and you look at the first slide, for the first bar chart is for this year and then it's the next year. So we are talking about serious loss of economic momentum across the board. And of course, some countries are affected more than others, depending on the openness of their economies. What's happening? I'm going to try and get to the next slide.
We can see the next slide.
Yeah, so you can see here, this is the OECD expectation in terms of how the world growth rate for different countries is getting derated. And of course, I think in reality, the downgrades will be much bigger. This was done about a month and a half ago. And of course, things have continued to deteriorate a little further. So the global economy is losing momentum very, very quickly indeed. And if we look at in terms of one of the drivers really is the pace at which the Fed is going to be raising interest rates. And of course, that slows the economy. And really, the expectation is that we are going well in excess of 3% on the short-term interest rates. And that really, in terms of coming from a zero interest rate environment, is a pretty large move. And this really, in face of an economy that is already slowing. So the question is the Fed going to be able to deliver the rate rises it is advertising? And that will really be dependent, of course, first on the data as it comes out. But more importantly, if we are already in the recession and the Fed continues to tighten the monetary policy, then really the depth of the recession could get quite large. And of course, the larger the recession, longer it will take to come out of it. And therein really lies the uncertainty that the markets are facing right now, which is why the markets are so very volatile. If we look at the last week numbers coming out of Fed Atlanta, you can see that the second quarter growth rate is now already estimated in the US to be contracting at 2%. Of course, in reality, we have to wait for the real numbers to come out. And the numbers on employment that came out last Friday were very, very strong. So there are parts of the economy that are incredibly strong, but there are other parts of the economy that are weakening very, very quickly indeed, especially on the back of both the fall in the consumer sentiment and business sentiment, which means that the retail spending is going to come under attack very soon. Higher interest rates, of course, ends up with higher mortgages and so forth. And effectively, you have a lot of debt out there, short-term and medium-term, and the cost of that debt is continuing to rise. So all of this will come and feed into disposable incomes, over the coming quarters. I'm going to come to this slide a little later because it's all about the real interest rates, and then real interest rates really effectively determine where the global economy goes and where the risk markets go as well. So just looking very quickly at the outlook for the employment situation in the US, we are now already at 3.6% on unemployment rate. So huge improvements since the COVID crisis. And what is good really for the general population is that the number of job openings are twice right now compared to the number of people looking for jobs. So basically, this is a very, very good time for employees and workers out there. And we have already seen that this is resulting into slightly better wages. So if you look at how the wages are increasing across the world, especially in the developed countries, and the US is the one normally one concentrates on, the wages are now rising on average, around 5.5%. And this is really important because, we have seen how inflation has spiked around the world. And a lot of the factors that were driving the inflation, a lot of them were first to do with the war, of course. And this is indicating the impact of the Ukraine war on the global inflation for this year and next year. So the numbers are quite meaningful. And this is really the transmission channel is really the energy prices, and of course the food prices and the fertilizer prices. And this is feeding through across the world. And the emerging economies, which have a much higher percentage in their inflation indices for food and energy, of course, are at the the blunt end of it, very large pressures in the emerging market economies. So if we just take a quick look at what is really in the last year and a half driving the inflation. And we started with the COVID, and then of course, what COVID did was that the pattern of spending, because you couldn't go to cinema, you couldn't travel, it meant that everybody was ordering goods on internet from home. And so the shape of the consumption demand changed from a balance between services and goods to much more on goods. And of course, goods typically need to be imported from faraway places. And so we had, on top of that, supply bottlenecks, because initially all the ships were in the wrong place, and then all the containers were in the wrong place. And so that basically was a huge problem, which only now we are in the early stages of actually resolving. And I'll come back to those two things in just a second. So what I want to do is, where is the inflation really heading? And of course, everybody underestimated the spike in inflation. And this is showing you the US, and we are likely to be getting to 9%. So the peak in inflation is still 1 or 2 months away. And in case of UK, it is quite likely that UK inflation will go into double digit, maybe topping out at 11%. And that is a bit more UK-centric because of the way our gas prices work. And we all know that the gas prices are going to probably rise by between 35 and 40% in October. And it's, again, fits through into everything. It's the way the pricing caps work in terms of energy in UK that drives the inflation in terms of when it's going to top out. So a lot of the factors that were driving the inflation are now going to reverse. In the last 10 days, when the first indication came on the table that the US economy was beginning to slow, what we have seen is a huge markdown in the food prices are down about 25% in the last 2 weeks, believe it or not. Energy prices are down again 20 plus percent. We go to the high of around $125, $30. We are now under $100. So a lot of the commodities in terms of copper and so on are down 30, 40% already in a very short space of time. So a lot of the commodity markets are already facing up to very sharp fall in demand and probably beginning to discount a recession out there. The shipping rates, the shipping containers from Shanghai to L airport have declined by 20%, 25% last week only, in last 1 week. So the things that were driving the inflation, which we initially thought were transitory factors, but proved to be much more resilient, transitory in the sense not 1 year, but 2, maybe 3 years. Some of those factors are now beginning to reverse. And that really effectively is a good news, but it's all about timing. So when we kind of bed down as to where will inflation be, say, 2 years, maybe 3 years from now, then the longer term issue becomes on where the wages are going to be rising and the shelter accommodation cost, how are they going to be rising? And I already showed a chart on wages rising around 5.5%. And the shelter, which is the housing cost, are rising around 10, 12% already and might come down. But all of this indicates that inflation 2, 3 years down the road is still going to be higher than 2%, which is the target. So inflation is going to be there a lot longer than people are expecting. I just want to touch on one of the things that is happening there, which is the withdrawal of liquidity, quantitative tightening. Remember that, last 10 years, we've been in an era of quantitative easing where central bankers have continued to print huge amounts of money. And Fed was printing until end of March, injecting liquidity. And it was the tide of the liquidity that was driving all the asset markets. That tide is now beginning to turn. So the right-hand slide is showing you how fast those central bank balances are going to decline. So on the one side, we got cost of capital going up with interest rates going up. And on the second side, the availability of capital is going to be declining. And so this to me is very important because we've been through an era where good, bad, and ugly had benefited from tide of liquidity. Now good, bad, and ugly is going to get sorted out. And we've already seen the speculative part of the risk markets, be they Bitcoins or meme stocks and so on. Specs, those of you follow, have all collapsed because, we went through a phase where companies that were loss-making but wanted companies with negative free cash flows going berserk. So that was all height of mania, height of the bull market, where no rationality really is present. Now, all of a sudden, we are in a much more difficult environment. What I want to do is I want to finish with this slide, which is that if I put all of this together and try to color code it, then the monetary policy is indicating things are going to get a lot harder. Monetary policy is really to do with the cost of capital. And we know that the cost of capital, other than Japan, is going to be rising everywhere. The emerging markets have been increasing interest rates much faster earlier because of the higher inflation impact. We know that the fiscal policy where the governments have been, after the spending so much money in COVID, the spending has reduced quite dramatically. So again, not very helpful from the economic viewpoint or the market viewpoint. Of course, if we get into a recession, then counter-cyclical policies will kick in automatically, and maybe governments will be forced to spend more money. If we look at the stock market valuations, of course, we got to a situation in S&P 500 valuation, which is a benchmark, and on a forward earnings, we go to 35 times, which is like, crazy levels. Historically, the S&P normally trades between 12 and 18, 19 times. Right now, we are about 16 times, 15 times forward earnings. So the valuations have compressed a lot. But if we are to go into recession, they can easily compress a bit further. And then when we look at the corporate earnings growth, of course, we were in the last 2 years, massive boost to the corporate earnings, and that corporate earnings growth is slowing. The market consensus expectation is still high single-digit earnings growth for this calendar year and next calendar year. And of course, if we are in a recession, going to go into recession, then the chances are that it's not the magnitude of the corporate earnings growth one should worry about. It's the sign of the corporate earnings growth. In other words, it's quite likely the corporate earnings growth could contract by 8, 9, 10% for the next 12 months. So at the moment, I would just say that let's just leave it at amber. But of course, if they begin to contract, like more than single digit, then of course it will go red. And of course, the sentiment is counter-cyclical indicator. Sentiment is now short to pieces. Everybody's frightened. Everybody's trying to exit the markets and risk assets. So in that sense, it's a green. Just a concluding slide, and it's the fourth point I want to just focus on, which is that one really needs to remain fairly conservative right now and minimize or reduce the volatility in your portfolios and be a bit more capital preservation focused until we have a much better benchmark on when the Fed is going to relent and reverse its interest rate rises, and it actually holds its quantitative tightening program. In other words, stops the draining of the liquidity. And when those happens, then we can look forward to putting more risk on. So thank you all very much for listening. And then no doubt there'll be a lot of questions which we can deal with at the end of the presentation. Thank you.
Thank you, Ashok Bhai. It was very stimulating as always. And, your insights are always predictable. You do really come up with those key points. I remember last we spoke in March on the same forum, and you were very much confident about that we will be seeing a near-term recession, and now we are very much in that same line as well. So thank you. Okay, so as I said to audience, we won't be really taking questions now after this, but we will wrap up the next presentation by our second speaker. And following which we'll do a Q&A round, and please post your questions via chat box and we can follow from there. So let's introduce our second speaker and start from there. So I'd like to introduce our second speaker, Anjali Shah. Anjali Shah is an investment director and portfolio manager at Aberdeen. Aberdeen is formerly known as a Standard Life Investment. She's managing their global mid-cap equity fund. She is also has a lead responsible for covering US small and mid-cap stocks within the smallest companies teams. Anjali's work has been recognized externally, including at Women's in Investment Awards. Prior to her career at Aberdeen, she worked as a sell-side equity research analyst at Oriel Securities and later Stifel Securities in London. She started her career on a graduate program with Prudential Regulation Authority, Bank of England. She holds BSc honors degree in economics from University of Warwick, and she's also a CFA chartered holder. So without further ado, I'd like to invite Anjali Shah for the next talk.
Thank you, Nitin Bhai and Jay Janendra, everyone. So as I'm sure you're all aware of the various headlines around challenging macroeconomic and geopolitical conditions, but really what I want to do in my session is talk to you about how that is feeding through into global equities. So what is happening in world stock markets? And is there a concern that we're entering bear market territory? So that is just a fancy way of saying a period of prolonged price decline. So share prices going down. So let me walk you through what has happened in global equities. So Nitin, if you go to the first slide.
Yes.
So generally speaking, global equities has been a strong performing asset class over the long term, albeit with some ebbs and flows. So the chart on the left-hand side shows that global equities have generally trended upwards since 1994, with a period of strong performance following the global financial crisis in 2009. Now, this is true across market capitalizations, so small, medium, and large-sized companies. However, as you can see on the chart on the right-hand side, global equities have had one of the most challenging periods on record. The MSCI ACWI index, which is an index made up of companies across the globe, has fallen nearly 20% year to date. And the market has been moving due to macroeconomic news, geopolitical uncertainty, and also a rotation into cyclical and value stocks. So if we look at the year-to-date performance in a bit more detail, January in particular was very challenging. It's not unusual to see a sell-off in January, as investors tend to sell stocks which have done well. They tend to make adjustments to their holdings. But this year, the sell-off has really been exacerbated by inflationary shocks. So as Ashok Bhai touched on, many economies are experiencing elevated levels of inflation. And in response, central banks are having to raise interest rates at a much faster than expected pace. This has led to a broad sell-off in global equities. And while we're not seeing a significant disparity in performance between market capitalizations, there is a disparity coming through between investment styles, so value outperforming growth. And this has been made worse by concentration in the market. So the initial unwind that we saw at the start of this year really triggered hedge funds and other algorithmic traded funds to sell out of their positions. The weakness continued into February and through to May because of the unexpected war in Ukraine, the very strict COVID-related lockdowns in China due to their government's zero COVID policy. And this has really fueled further concerns around supply chain disruption and ultimately inflation. So overall, we are now in a situation that is far from normal. We have changing interest rate environment, COVID, war. These are all extraordinary events. And we're seeing this debate shifting from inflationary to growth concerns. So if we go on to the next slide, we can delve into how macroeconomics and geopolitics has impacted different sectors. So the only sector to have delivered outperformance year to date is energy. The ongoing Russia-Ukraine conflict has led to concerns over potential gas shortages, and as a result, prices have risen significantly. Just think about how much more you are now paying when you're going to pull in petrol for your car, when you're at the petrol station, or just think about how much your home energy bills are increasing. Energy companies are enjoying bumper profits and they're distributing this as dividends to their shareholders. So energy stocks, as a result, have held up fairly well year to date. The sharp reassessment of the interest rate outlook has led to an exodus in highly rated growth names. So these are stocks which appear to be optically expensive, as the vast majority of their growth and therefore potential value will be realized in future. And this can help to explain some of the underperformance we've seen in sectors such as IT and healthcare. Industrials have underperformed because these stocks and these companies have borne the brunt of rising input prices. There are also mounting concerns over consumer spending, and that is really weighing on discretionary names. So just think about the cost of living prices, the headlines that we're reading, and just having far less money to go out and spend on non-essential items. So you might be sitting there wondering, okay, so Anjali, what can active fund managers do, or how are they positioning their portfolios? Unfortunately, there's not a single clear answer to this question, as it will depend on each fund manager's investment process, style, behavioral traits, and other biases. So fund managers typically have to follow an investment mandate, which outlines what they can invest in. So, for example, what is their allowable universe from which to pick stocks, their style of investing. Are they quality investors, growth investors, value, income? Their time horizon, are they short-term or long-term, and any other rules around sector, geographical, or benchmark limits. Fund managers are typically reluctant to deviate significantly from their investment mandate, as this is effectively what they have agreed with clients or what clients have signed up to. In a fast and sharp market environment such as this, there can be limited ability or indeed willingness to make significant changes to a portfolio in order to reverse performance in the very short term. For example, fund managers who are mandated to invest in high quality and growth stocks and who have a long-term time horizon are unlikely to switch to buying very poor quality companies or value stocks. But in what they may have been doing instead is taking actions such as just being more mindful of the risk exposure within their portfolios. So for example, reducing exposure to companies that have a higher discretionary element to revenues, or maybe facing a greater degree of margin pressure, and adding to companies who have greater predictability because a greater portion of their revenues are tied to non-discretionary elements, or they're highly recurring in nature, or those companies with strong balance sheets. So are global equities cheaper? Nitin, if you go on to the next slide. So as you can see from this chart, global equity valuations have come down considerably. Valuations across geographies, with the most noticeable exception being the US, are already below their 10-year averages. And in a market obsessed with macroeconomics, geopolitical news, company fundamentals are being increasingly overlooked. Now, some may view this as a potential attractive entry point into what has been an outperforming asset class over the long term. The majority of companies continue to see strong demand at present, although it's yet to be seen what impact rising inflation has on consumer spending and input costs, and therefore margins. In this uncertain environment, there is growing concerns around the risk of stagflation or recession. And it's worth noting that significant sustained declines in equity markets are tied to persistent negative economic and earnings growth, so a recessionary environment. Now, as Ashok touched on, it's highly anticipated that we will see a global economic slowdown in the back half of this year or early next year, although the extent and magnitude is still being debated. One thing that we have learned from the last recession, so during the global financial crisis, is that company fundamentals and quality really matters. So in my opinion, in a recessionary environment, it would be reasonable to expect a flight to safety. So with quality companies outperforming, investors need to be careful in their exposure to ensure that they're not left holding poor quality companies simply for their cheapness rather than their long-term durability. Value and cyclical stocks tend to lack inherent growth, but companies who are able to demonstrate their ability to grow because of structural trends rather than short-term cyclical drivers, and those that can deliver positive earnings through macroeconomic cycles, may actually fare better over the long term. And as we're heading into earnings season, so when companies are reporting their quarterly results, the market dislocation could present opportunities to buy companies which fit this attractive profile, but at potentially more attractive valuations. So overall, investors need to act rationally, balancing near-term downside risk with long-term opportunities. Thank you.
Thank you, Anjali. Thank you. And it was very, very valuable insights for our audiences and investors who are actively, managing their portfolio. I think hearing from somebody who's day-to-day managing a portfolio for a big investment bank, it's definitely much greater learning. I'm sure how they can use those tips and ideas for managing and reevaluating the portfolio in the in this bear market. So once again, thank you, Anjali, to share your insights. I would like to just go to a quick announcement before we proceed with the Q&A round. So we have to share. So just as a part of I would like to just share that why somebody should become a GITO member. Joining GITO is a part of, global GITO is a global network for business leaders and professionals and entrepreneurs. GITO allows to connect like-minded people locally and across the globe, particularly within Jain community, and empowers yourself to share, connect, and promote business ideas and trade. So anybody interested in GITO, please reach out to this website or to me or membership@gitouk.org. That's the first thing I'd like to make an announcement for. And what's exciting ahead as well. So as we have more events coming in, and as Amit highlighted in his welcome note, we want to really go hybrid going forward. The pandemic's learning is we will have a blended approach of events throughout the year, rest of the year, as well as in the future. So our next event is September 18th, save the date, and we will really coming with more ideas and learnings around investment, retirement, pensions, and will preparations, and so on. So please look forward to receiving more information on that. So now I'd like to really start the Q&A sessions, and I can expect more questions coming in from the chat box, but please send as we are going through question rounds. So let me just. Okay, so thank you once again, Ashok Bhai and Anjali. It's been really great insights from the latest trends you have shared, but I think there's a lot going on, isn't it, from last 1 week in terms of UK particularly. So I'd like to really, before we go into the deep questions about the investments and the trends of the macroeconomic, what's your thought, particularly, with very turbulent week happened last week with the resignations from various ministers and eventually Boris Johnson. So we really need to look for a new prime minister as well in some time. So what should be the priority for UK's next prime minister? Tackling cost of living crisis, labor shortage, forthcoming recession, or really filling the deficit hole we have created over the pandemic period? So first to you, Ashok Bhai, from getting the insights, how should really things pan out from economics perspective?
Okay, thank you. UK was already in a political mess, that Brexit had been going on for such a long time. We still, hang up from Brexit, basically we missed out on the capital spending cycle, which meant that we really missed out on really wealth creation cycle. And then with the policies where, on the labor side specifically, where a lot of the people that come from Europe left, went back, that meant we ended with a slow economy with shortage of labor, which is a very, very bad, nasty position to be, because shortage of labor implies that a lot of the cost of input start to go up, wages go up. You don't have people to, on the farms or in the restaurants or whatever. So that, again, increases the spike in inflation, which is why UK's inflation is a couple of percentage higher than the US. Now, in terms of the politics, I think, it will just remain very messy. And, we just, the proof of how bad UK is to simply look at the way the sterling has been behaving in the last 12 months. And, we are now below 1.2. And people are talking about, can it go to parity? Just like in dollar, euro is gone almost to the parity. So in a way, US dollar is rising because of the US interest rate cycle is far more aggressive. US economy can take much bigger interest rate rises than UK economy. UK economy is much weaker fundamentally. So for the capacity to raise interest rates in UK is much more restrained despite inflation being much higher. So I think all that the political mess we are in, it just doesn't give any room for anybody to change the negative stance in UK equity. It just makes it worse. So in the short term, there is no relief at all. Whoever comes into power, they're going to be inheriting a pretty big mess. And UK is probably very closer to recession than US is, if not already there.
Okay, that's not definitely positive, but I think that's what you have to be said is said, isn't it, Ashok, from the perspective of how it's going to pan out from that perspective. Anjali, over to you. I mean, from being as a portfolio manager, I mean, what do you see how things will and what proportion of impact we will see from the portfolio perspective?
Sure. So when you're looking at indexes such as the MSCI or Companies World Index, the UK weighting within that is roughly 5%. So it's meaningful, but certainly not the biggest driver of the global index. And again, it comes down to how fund managers invest. So what is their investment process? Now, if they are top-down investors, they are more likely to take views around certain geographies, macroeconomic trends. And as a result, I would agree with Ashok Bhai that the UK certainly is not looking very attractive at present, although the valuations have certainly come down. But if you are a bottom-up fundamental stock picker, in some ways your job is to trying to ignore or navigate through all of the noise that you read around headlines and macroeconomics and just pick companies that are really good companies to hold over the long term, where you're going to be rewarded as a shareholder. And when you're looking at things from that lens, I would say that you want to find companies that whose revenues are perhaps tied to non-discretionary elements, so they're not dependent on the UK consumer having lots of spare change in their pocket to go out and shop for, I don't know, things like trainers, for example. And you're also looking for companies that are market leaders within their niches. So ideally, you want companies that have pricing power. They are not price takers. Therefore, in a rising inflationary environment, they have the ability to raise prices and pass that on to their consumers, thereby protecting their margins. So I think when you're looking at UK companies from a bottom-up fundamental stock picker perspective, you're looking for these type of traits to determine whether this is a UK stock worth buying.
And just to add, of course, the FTSE has, relatively speaking, outperformed year to date. And of course, the reason is that it's full of, mining companies and oil companies. And of course, it's full of banks. So in that sense, you're talking about companies that are highly cyclical. And of course, they're all highly vulnerable should there be a global recession. They benefited because of the energy spike and stuff like that. Initially, they benefited because of the shape of the yield curve was changing in favor of the banks. But again, things are getting bad because if we get a recession, you will end up with non-performing loans that the banks have to absorb. So I think a lot of the good news in terms of the outperformance for the UK equities is already on the table. And investing is all about future, not past. And you have to ask, what extra can the UK equities deliver? And it's very difficult to, they belong to the value camp. And value had a good time because growth got hammered. Higher interest expectations drives the value of the future earnings streams down much faster. Whilst, if you got value stock is much more dividend driven, much more now, not longer term growth. So those drivers, I think, are in process of changing.
That's very useful, and I'm sure our audiences are hearing that if it does become parity to the dollar, the sterling, we will be in really having more expensive holidays everywhere. So hopefully it doesn't go that way southward, but we all can't control, and politics will have to play its card. Now I'd like to really touch on something you already highlighted about the sectors, particularly how the FTSE and the investment sectors and one of the slide, Anjali, you presented was very interesting around, all sectors were declined since January to May, except energy sector. And our audience also have a couple of questions. So despite bear sentiment, do we identify sectors, which will counter these all inflation rates, interest rates, inflations, as well as, and do you think, are there any comments, especially around the mining sectors, particularly, from that perspective? So how do you see that pan out?
Yeah.
Over to you, Anjali.
Okay, so I think this is where perhaps Ashok Bhai and I may have a slightly different view, because he is someone with more of a macro top-down hat on, whereas I am a bottom-up fundamental stock picker. So as I said, it's not really my expertise or job to kind of find what is the best sector to invest in and then find the companies. I do it the other way around, where I find the best companies to invest in regardless of what sector they're in, and then try to build a portfolio that way. But in terms of just the kind of broad outlook for sectors, I think certainly sectors which are more exposed to short-term macroeconomic cyclical trends, dependent on consumer discretionary spending, seem to be the ones that are really going to struggle. They've already started to come off significantly, and they're the ones whose revenues are not contracted. They're not ones who have a high degree of recurring revenues. So those are sectors that I am cautious of. I am just being mindful of my exposure to them. But sectors which I think are good long-term structural growth sectors, so areas like IT, healthcare, industrials, I think these are good sectors to be in for long-term investors. But again, I think it comes down to what you are picking within that individual sector. No one company is the same as another. Every company has its strengths and weaknesses. But again, I would encourage you to think about investing in stocks in such a way that you're picking high quality companies who are able to weather storms better. So whether that is because they have contracted revenues, so a higher degree of recurring revenues on subscription, a higher degree of pricing power, perhaps they have a high degree of market share with limited competition. These are the things that you should look for in order to see that that margin profile can remain intact, and as a result they can continue to deliver earnings through economic cycles. So Ashok Bhai, in his presentation, he touched on the fact that a lot of companies may face growth challenges as the economy slows. So ideally you want to find companies that are growing. Now, on this presentation, I'm not allowed to mention any of the specific holdings that I hold for compliance reasons, but there's a number of companies where, if you think about the nature, the product or service that they're providing, so take something like healthcare, you will have companies that are providing essential medical pharmacy, medicine or healthcare services, which regardless of what's happening in macroeconomics, what's happening with the UK government, you still need your medicine, right? So for example, my dad has high blood pressure. He can't not take his high blood pressure medicine. So again, these are the kind of companies that are more predictable in challenging macroeconomic conditions.
That's very helpful. Thank you, Anjali, and I'm sure it's very useful. I don't know, Ashok, if you want to touch upon quickly on.
Yeah, I think it's a very good explanation from Anjali. The two main points I want to mention. One is that, really speaking, when the cost of capital is going up, like 10-year yields are going up, the whole market has to re-equilibrate, irrespective of good, bad, and ugly. So this is headline driven. There's nothing you can do about, individual sectors. Everything goes. And maybe large part of the pain in terms of the 10-year yields moving up, is already on the table. Maybe there's a bit more left, and that is really a question of how much liquidity Fed decides to withdraw. If it decides to withdraw $1 trillion, which is what the market anticipation was, between $1 and $1.5 trillion, it's quite likely that 10-year yields will go from 3% where they are now to 4%. We go to 3.5% and we come back. And if that is the case, then the whole market, valuation forward is going to come down maybe another 2 basis points, from 15, 16 to maybe 13, 14. It look very cheap, of course, at that level. So that's the whole market. You can't fight the cost of capital. The second really is that, we don't know how deep, if the recession comes, is going to be and how long it's going to be. So it's this level of uncertainty that is in front of us, which is telling you nobody knows it. Okay, you can guess and you can speculate, but nobody has a clue, because the central bankers are going to be data driven, and a lot of the stuff that's going to happen will be emotional in terms of households deciding to tighten their belts. And you heard 2 weeks ago, they asked the guy saying that more and more families are putting £30 checkout limit. Anything in excess of £30 they don't want. £30. What can £30 buy, for God's sake? So just imagine if this goes worldwide. So there's a lot of uncertainties out there. So in terms of total risk and how you apportion the risk, different asset classes is one equation to solve. And then completely separate, it's an equation that you know how much money you have in equities. And yes, what Anjali said, it becomes a very big driver. But really, in one very simple sentence, you want companies that have low leverage because cost of capital is going up. You want companies that have free and resilient free cash flows. In other words, they are stable. You know that the volatility of their earnings cycle is relatively contained. And therefore, your dividend stream that you're going to get from them is going to be good. And hopefully, they benefit from inflation because they can protect margins. Their free cash flows will rise in line with the nominal GDP, which means your dividends are going to rise, which in a market which is soggy at best and could be down another 10, 15% at worst, then those kind of companies eventually will bail you out. So I think that's more than enough.
Yeah, absolutely. And I think it's, as Ashok Bhai said, this era of free money or helicopter money from central banks is definitely coming to an end. So, you think about something like, say, the IT sector, we've all read about the FANG stocks of Facebook, Amazon, and so on. And, they seem great on paper, growing rapidly. But, there comes a point where you need companies to prove their ability to deliver not just revenue growth, but also profitability and, importantly, cash flow. And I think you really do start to see the market differentiate between companies that are providing profitable and cash in these kind of market environments.
Right. I mean, I can relate very much to this sector. The high valuation, high flying startups definitely we are in that zone. So I'd like to really move into different part of the, and I think it affects everybody on the call. And I think we all have been to that life cycle, and it's key component. When we think about interest rate, it affects other things in general, interest rate, but I think it goes directly and hits our pockets, and the mortgage rate goes up as well, right? So what I want to understand, and what's your thought is, or as you highlighted, till the end of December, I think we're going to see continuous furthermore increased rate in, rate of interest, will be going up. If Fed's doing, I'm sure Bank of England will also do as the trend. How would you recommend our borrowers, to remortgage their properties, or, what should the borrowing term should be? Should they look into, say, stick with 2 years or think about 5 years, because things are not going to get rosy as soon as possible, right? So just wanted to understand and hear from your thoughts, how you see that.
Okay, let me just cover that very fast, and then Anjali can come a bit more in detail. So let's just focus our mind on what happened to the US, and we can come to UK in a minute. So the 30-year mortgage rates, were under 3% not long ago, a few quarters ago, and we've got through 6 and a change, 6.2%. So the cost of 30-year mortgage is, double. And in the last week, it's come back with the anxiety about are we in a recession already to 5.3%. However, so there's a significant increase in interest payments for remortgaging or for new mortgages. Of course, as I said earlier, the ability of for UK to raise interest rate is very, very restrained, because we are already a weak economy. We are probably much earlier, nearer to tipping into recession, which will get even nasty very quickly. So yes, interest rates will go up, but not that much. And of course, from a household point of view, managing your financing, managing your funding and cash flow, it's important that you have some stability, some certainty. And therefore, without looking specifically at today is a good day or not day, or was last week a good day or not week, is that, you know, you want to fix your mortgages for a few years if you can, because it's your lifestyle. It gives you stability in what else you can be doing. So you don't want to be on, you know, floating rate or 1 year rate or 2-year rate. You know, you'd rather be on 5-year rate. The 5-year rates have gone up, but not significantly. I mean, historically, they are very cheap. You know, remember, my first mortgage was 15% and going up to 17. So, you know, a couple of percentage on mortgage rate is still a giveaway.
Wow, I'm sure I would not have thought about 15% as in reality in my life cycle as a mortgage rates, but I'm sure I've heard from many that they have been really experienced that. I don't know, Anjali, if you want to add any points there in terms of the, you know, any advice, or it's something you want to.
Yeah, I think Ashok Bhai has really covered it all. I guess you can say whether I'm fortunate or unfortunate. I was born in '89, so this is the first real period that I'm seeing of interest rates rising significantly. So certainly the mortgage that I have is nowhere near the rate that Ashok Bhai ever had to pay for his initial mortgage. But I think, you know, it is something to be mindful of. You know, if you can lock in a fixed rate at a good deal, then that would seem sensible at present.
Excellent. I think I'm sure our audiences are hearing that, you know, things are not going to get rosy anytime soon, or back to, you know, sub-zero interest rate. So let's move into a slightly different direction. And I think I want to really touch on something, you know, macroeconomically impacts everybody as well. But, you know, what is your thought on global dominance of dollar, right? Is it in decline? Because there are several examples where we see the East has learned to trade. Russia has lived through thrive on the economies and trade, irrespective of the dollar dominations or control. I mean, you know, so do you think we are going to have 2 words where the business as usual without dollar being, you know, be a vital role? And how do you see that panning out?
Okay, so I mean, I don't think that the dollar's dominance is going to be affected in our lifetimes. You know, yes, there are alternative currencies trying to come up for a long time. Everybody thought euro was the more, you know, a suitable replacement, but of course, just get our heads around what I'm talking about. It took almost 150 years for all the individual states in the US to accept dollar as their main currency. 150 years journey, yeah, before all of the individual states agreed and signed up a common dollar. In case of Europe, we are at the infancy stage. We are in the first 20 years when euro is still established. They do not have a common fiscal policy, and, you know, monetary policy is one shoe fit all sizes, and you got new nations still joining. So I think it's going to be a long time before euro becomes a real competitor to the dollar. At the moment, you know, as long as the German balance sheet stands behind the euro, it can hold it together, but the fringe, you know, Italy is always vulnerable to a default. If interest rates go up, you know, like they almost recently went up a month ago, I don't know if you're monitoring it, you know, ECB had to have an emergency meeting in order to come up with, you know, anti-breakup plans, currency, you know, convergence and all that. So euro is not going to be a competitor for the US dollar. So your only real competitor is renminbi, the Chinese currency. And of course, again, if you think about where renminbi is going, it's a long haul. They still have capital controls and restraints, and individuals in China cannot take their money out at will and so forth. So until they liberalize the Chinese capital markets completely, it's not going to be able to really become a major part. If yes, the total international results held in the dollars have gone up, you know, gone down by about 5 percentage points in the last 5-6 years, and might go down a bit more. But bulk of the global trading is dominated in US dollars, whether it's commodities or energy or whatever. Countries have tried to, like Russians have tried to price and get people to pay in rubles the energy, you know, purchases, but I don't think it's going to be very successful. There's been some trade that China has tried to link many countries and do it in renminbi, but it's still in very early stages. So yes, you know, there will be dilution of the US dollar, but I think that the way that the US Federal Reserve Bank is really the world's you know, central bank, and as long as it does its job properly, then few countries would not want to remain in that kind of a trading system. So I think that the relative strength of the US economy, the relative interest rate differential, the relative inflation longer term differential, everything is pointing to the reason why the dollar is going to remain intact, and there's no reason to really be frightened about it.
Okay, now that's I'm sure very inciting. I mean, 150 years is a lot of time to establish a currency within one country. So I'm sure, getting a global dominance will not be easily replaced by anybody else. So that would definitely, I don't know if Anjali, if you want to have any thoughts, or you think it's great. So thank you, Anjali. So now I'd like to move on to, something more interesting around the investments and the style, particularly, how we're seeing it. So, the question from one of our very own Jito person is, should people in their early phase keep investing in funds regardless of state of the market, or should older investors begin to shift out of equities to fixed income or something? What's the thought there?
Okay, so naturally I'm going to be biased because I run an equities fund. So I will tell you that equities is a good place to invest, particularly for long-term investors. Ashok Bhai will be able to touch a bit more on specific asset allocations, so whether equities, fixed income, and so on. But I think just from a kind of global equities perspective, so ultimately it comes down to what your time horizon is. I mean, speaking in very general terms now, equities generally are a good store of value. They have trended upwards over time, as I showed in my presentation. And they are, generally speaking, also good in inflationary scenarios. Now, this particular environment has been very unusual because of just how quick the change has been. That's caught a lot of investors off guard, hence why we've seen this market gyration. But I think ultimately for long-term investors, global equities are still a very attractive asset class to be in. And also when you look at valuations have come down significantly year to date. So we're now actually at or near below the 10-year historic averages across the globe. Now, as Ashok Bhai touched on, there is a risk that they could continue to trend down, particularly if we have a prolonged or severe recessionary environment. But again, it's about balancing that near-term risk with those kind of long-term opportunities. So, if I was to put it to you very bluntly, it might be the case that you look to buy something a bit more cheaply now or in the near distant future in the hope of holding it for a long time where you see that value grow again. And then you could potentially sell out of that asset at a higher valuation. So, for me, I still think that global equities are attractive, but I think you need to be mindful of what you are buying. So when you're looking at particular styles of fund, as I touched on several times already today, I'd really be looking for funds that are investing in companies which are high quality in nature, that can weather the storm. You don't want to be holding funds or stocks in companies that are simply cheap and they're completely and utterly dependent on the macro and cyclical drivers. Just think about, if you have a company that is completely and utterly dependent on short-term macro cyclical drivers, the moment the economy stops growing, those companies are in trouble. They lack inherent growth themselves. You want companies that are growing regardless of what's happening in the macro environment. So ideally, companies that are growing because of long-term structural trends. So, just take digitalization. Today is a perfect example. Previously we may have all met face to face to have this seminar, but we're increasingly making use of these digital tools. And I don't think we're going back to a world where we're suddenly going to go back to pen and paper for doing things. We're still always going to be advancing our technology. These are structural trends that were here before COVID and have only accelerated due to the pandemic, and they're here to stay long term. So these are the types of companies that I would look to back. I'm sure we'll touch on ESG later, but again, the transition towards a green economy, these are all important drivers for the future. So these are the types of companies I would look for. So when you're looking at investing in a fund, you really need to be mindful of the investment style and what type of portfolio holdings they have within that fund. But I'll let Ashok Bhai touch on whether to go for equities or bonds instead.
No, that's a very good explanation. So I just want to touch on something much more at the top, general. So if we can get our minds around it, then we can worry about how much we put in equities and what kind. So we are coming through a period where we had a structural supply-demand imbalance, and that created inflation. And central bankers cannot create supply. They can only manage the demand side of the equation. And I think it's quite evident that there had to be demand destruction. And the demand destruction is effectively sanctioning a recession. That's how you reduce the demand in order to re-equilibrate, because none of the central bankers want to tolerate high inflation for a prolonged period of time, because the credibility goes out of the window and the cost longer term is very high. So right now, even though in effect, we already seen, as I say, in the last week, 10 days, how fast some of these commodity prices, shipping container costs, how they're coming down, and can come down a lot more after volatility, of course, that all of that is saying that we have a mini recession, and we don't know the depth of recession, which is what we have to wait. Because if the forward markets on interest rates are true, then, the recession is going to be quite severe. And if the quantitative tightening continues like what's been advertised, then again, it's warranting lower volatility embedded in your portfolio construction. Remember, whatever volatility you embed, you can invest low risk part of a volatile asset market. You can be in the safest segment of the equity market, which are your, long-term sustainable growth, blah, 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 blah. So that's the first point I'm making, which is that really in terms of risk that you want to put in, one needs to be at the lower side of your tolerance, not the higher side. And of course, markets being so volatile. And if you look at the volatility of the risk markets, and you look at WIX, S&P 500 volatility, and you look at the last 50 years and last 20 years and last 10 years, where are we going now? Long-term historical average for S&P 500 is around 17, 18 times. And we spent last 10 years broadly below that. And the next 10 years are going to be broadly above that, given inherently the uncertainties I'm talking about. So if you had on an ongoing basis equity allocation, you had a risk budget of X and is part of that, then unless you increase your risk budget, your holding of the equity exposure has to come down. And you may actually take out the volatile price of the equity part of your equation to stay same level of equities, but safer segment of the equity. And that's what you probably, a lot of people are doing. They're going to remove their cyclical equities, which tend to be more volatile, risky. They might tone down their IT part of the stuff because it's more volatile. Yes, long-term growth, but it's more volatile. So there are different ways of managing risk in terms of portfolio construction. But right now, given the sell-off that we have seen in the fixed income markets, the fixed income all of a sudden, who wants to buy negative yielding asset, guaranteed to lose your money if you hold to maturity? You have to be really dumb to do that. We had $18 trillion worth recently of the total negative trading assets. Yeah, so world had gone crazy. Now, investment grade bonds can give maturity 5, 6, 7 years. So that's not bad. It might get another 1 or 2% up. So all of a sudden, an asset class that was out of favor is giving you reasonable rates of return. The high yields, which had compressed, they were giving you silly. You're not getting paid to take any risk. All of a sudden, the yield structure on the high yield has doubled from about 4.5%, 5% to 9%.
We're losing Ashok by
an attractive asset class. So what I'm saying is the changing dynamics. And this sell-off is creating a lot of values, good, bad, and ugly is getting thrown out. As Anjali said, the very good quality companies with fairly good potential have been marked down because what happens in a sell-off? People have to sell good assets to fund the bad assets. Bad assets go illiquid, you can't sell it. Margin calls keep coming. You got to fund them. And you have to sell good assets to pay your margin. So we're going through all of that clearing of the math. In that volatile, messy situation, value gets created, and the next 5 years is Time for people like Anjali. Foot soldiers, looking up, roll up your sleeves, go through the revenue account balance sheet and say, here is something that is unfairly priced because it's half what it should really be worth. So we are completely into a different season where we were in the season for the last 10 years. You threw a dart ball and everything succeeded. That season is gone for good.
Great. So that's very well said, Ashok Bhai. I think the dart ball doesn't work anymore. Do your hard work when you're investing your money or putting your money in. I think that's the message I'm hearing from both of you. Given we are just on the time, I think so very quickly, I'm going to take two more questions, one from audience and one definitely want to touch as a part of the future thinking about this event going forward. So how about Anjali? I'll come to you, particularly from, so how, we would like to really understand, and for audiences as well, there is a new investing themes is coming up in the market, or probably not new as we see it, but ESG investing. And I know, and I hear from, based on our discussion, that is, you do look into those as a very specific criteria for investing in, building a portfolio as well. So would you want to explain slightly more in terms of what is ESG investing is, and how does really, what are the key parameters or, trends you're seeing in that particular type of investing, just as a start of the call?
Okay, sure. So for those who are unaware, ESG investing stands for investing in environmental, social, and governance aspects. So that's what the acronym stands for. Now, different people will quantify and define ESG in different ways. There's no standard definition used by all fund managers across the globe. So it does make it tricky to compare apples with apples, if you like. But broadly speaking, you're looking to invest in companies that are having improving or already good ESG profiles. So you're looking for companies that have good governance practices. So, companies where, say, the chairman and CEO role is separated, there's a high degree of independence at board level, there's a high level of diversity at board level, whether it's gender, racial characteristics, or other characteristics as well. You're looking for companies where you can see that the remuneration of C-suite executives and key managers are aligned to how shareholders are looking at these companies. So are they being measured on metrics that we also care about? On the social side, you're looking at things like, what are these companies' supply chain policies? Are they auditing their supply chain? Are they doing good for society? So, for example, if you have a healthcare stock, is their drug really helping someone to lead a better life or have less burden in terms of healthcare? Are they helping to reduce the cost of that healthcare? What are their labor practices like? Are they a fair employer? Are they conducting employee surveys? And on the environmental side, you're looking at what is the environmental footprint of this company. So are they being mindful of how they are producing or delivering their their product or their service, but you're also looking at whether they've set specific target emission reductions. And more we're seeing companies are being a lot more mindful of ESG, because this is something that really matters to investors. We're seeing a huge degree of inflows or more money coming into funds which are labeled ESG funds, or which aim to promote sustainable development, that aim to promote something called impact investing, which is even a step beyond ESG. So we're seeing more and more demand from fund managers such as myself of companies for this type of information, for this type of disclosure. And we're seeing companies responding by publishing annual ESG or corporate sustainability reports, setting out very clear targets. We are seeing some degree of geographical difference. So if I can make sweeping generalizations, I would say that the EU, European Union, UK are probably furthest ahead when it comes to thinking about ESG in terms of disclosure, reporting what they're doing. We're seeing that the US is somewhat behind, but catching up. Asia, it's a bit more challenging because You have a lot of small and medium-sized companies in particular where perhaps they don't disclose in English, so the metrics are not being picked up in the right way by external agencies and so on. So there's perhaps more to do in that region, but it's certainly an area that's really important. And people always ask me, right, okay, so Anjali, you're a Jain, and you're a fund manager, so surely the two don't mix together. Like surely profiteering of people's misery, or what good can investments do? But actually, ESG investing highlights how those principles can come very closely together, because you are picking companies that are doing something good for society, that are doing something good for the environment, that are promoting good behavior, good characteristics. So actually, I think ESG is a really interesting area where we're seeing more and more people interested in it, more inflows, but an area where investing in these companies, they're challenging the status quo, they're disruptors, but doing so in a way that is good for society. And there are various studies out saying that companies with good ESG credentials actually deliver better performance as well. So there's a financial benefit to investing in these companies. And I think particularly from a person who invests in small and medium-sized companies, people often talk about ESG as what are the risks? What are the risks? But actually, ESG can absolutely be an opportunity as well. Just think about companies that are, tackling the carbon crisis, or tackling climate change through innovative products, companies that are coming up with new drugs. So I actually think it's a really interesting area. Different fund managers will apply or do ESG differently. So some will have it embedded as part of their investment process. So for example, when they're looking at quality, they're looking at ESG credentials. Other people, their fund will go a step further. So for example, if it's a, without getting into all the latest regulation, but if it's a SFDR Article 8 fund, or it's, labeled as an impact fund, they specifically have to, take the universe and then cut out things which don't meet certain criteria. So you're already looking for good companies to invest in that are good ESG profiles. So it's an area that is definitely getting more and more interest, and something that, as a Jain, I feel very passionately about, because I think that is two areas which come together quite nicely and shows that not all fund management is for evil or bad purposes.
Exciting, fantastic. I mean, the key message for the audience is definitely the Jainism and ESG go hand in hand, and I think it's something we should really be proud of, based on the principles of Jainism. But at the same time, the whole world is looking into the same aspects, but different perspective. So thank you, and that's really good insight. I'm sure we will touch on the ESG investment in future as well, more webinar as well. So I'd like to go to a final wrap-up question. Over to you, Ashok bhai, particularly, earlier in the talk, you suggested that inflation would continue even though commodity prices are declining. As you said, in last 1 week, a lot has changed on the commodity prices. So could you please elaborate what would drive the inflation, and from the perspective, so just that the audience understand what is really going to be playing here?
Yeah, so really, I mean, when we want to think about medium-term inflation situation, what we want to think about is the parts of the inflation content that become self-feeding. And the two most important ones really are the wages, because once wages start rising, the expectation is that I will continue to get wage rises, and your inflation expectations for your general population begins to start rising. So that becomes very hard to reverse. It's a long haul and a painful haul. So first is the rate at which wages are rising. The second one really is because, especially in the US and maybe in many parts of the world, housing costs is again something that's quite big, normally tends to be stable. In case of the US, it's implied rental cost, which goes into your core CPI, producer, all the various indices. So that means that keep an eye on how the rental growths are going, and the rental changes have been quite strong. They've been double-digit in the last 12 months. So again, at the margin, the inflation in very volatile elements is slowly shifting into what I would call the worrying part of the inflation spectrum, the wages housing costs. And really, ultimately, it's the wages that you have to keep your eye on because it changes the behavior and everything else. And at the end of the day, you can't create workers. If people decide to retire early or give up working or whatever, your participation rate goes down. It is very, very hard to bring it up quickly. And of course, we've seen the total number of women entering the workforce has been rising steadily, etc., because more facilities are available for childcare on this. So it's ultimately the supply of labor. And superimposed on that is that you need a capital spending cycle because that produces your productivity gain, which then, if your wages are rising at, say, 5%, and if your productivity gains can be 2 or 3%, that means that the real net input is maybe 2% on inflation, 2.5%. So that means that it's not an issue. But that can only happen, productivity gains only happen if you do new capital spending cycle. Now, capital spending cycles are going to slow across the world given the rising cost of capital and everything else. So I think inflation is going to be coming down because the volatile parts are going to come down and reverse, and the base is already higher, and to build from a high base gets that much more difficult. So it's a question of what is the period before inflation goes to this central bank's benchmark of 2%. And I think you're talking about 2, maybe 3 years and not 1 year, 1.5 years, which the market, not market, but that's what the central bank's projections indicate. And I think they're being very optimistic. And the only way you can get that is that you have a pretty nasty recession in the meantime.
That says it all, Ashok bhai. I think, we will still be paying for more fuel, more for the fuel, more for many other things. So keep your wallet tight, I would say to everybody. And I think, just try, I guess, you've connected the dots very well as well, because of the labor shortage, because of the, the higher interest rate, we will be experiencing the heat of, inflation, no matter where we want to, however great the economy is going to do. So thank you both. It was really very exciting and interesting discussion, and I'm sure our audience also enjoyed it. So thanks once again. I'd like to invite Amit Bey to do a word of thanks. So over to you, Amit.
Thank you, Nitin. As you've seen, another excellent show by G2 UK. I think there is a great value and rewards in becoming a member, as it opens the doors to a variety of such events, workshops, vast network of like-minded people, entrepreneurs, professionals, and also mentoring opportunities. I would like to thank our distinguished guest speakers, Ashok Shah and Anjali Shah, in providing a great overview of the current economic trends, especially on inflation and then ESG, which was quite interesting. Thanks to our sponsors, ICICI Bank, for supporting G2 UK, and thanks to all the attendees for participating in this event and asking questions, which subsequently led to an interesting discussion and depth of the topics. Many thanks to Nitin for supporting this whole event, and also the Zoom coordinators, Girish and Sulabh, but last not least, the whole of the G2 UK Executive Board for your great support in running this event. Have a good day. Thank you.
Thank you, everyone. So I'd like to close the call now, and thanks. Have a good afternoon and sunny day, sunny Sunday. So enjoy your rest of the day. Thank you.
Thank you.